Should you be using cash or accrual basis accounting? This is an overlooked question by a lot of starting entrepreneurs, but it makes a vital difference. In this video, I'll explain both the cash and accrual methods, tell you about the pros and cons of each, and then tell you which one's my favorite. But to start, why does it even matter? Accounting is an important function for any business as it helps owners and managers understand the financial health of their business and make better decisions. The information provided by each method is actually quite different, so understanding the nature of those differences can have a big impact on your decision making. So what's the big deal about cash versus accrual accounting? These are two very different methods of recording and reporting financial transactions. And specifically, they differ in how and when transactions are reported. Cash accounting is a method where all the transactions are recorded when cash is received or dispersed. That means that revenue is only recognized when cash is received from a customer, and expenses are only recognized when cash is actually paid to a supplier. For example, in February, I sold $1,000 of a product to a customer and shipped it to him. Even though I've already done everything I needed to, if he only pays me in March, the revenue will be recorded in March. Similarly, say I pay for my annual insurance premiums. If I pay $12,000 to the insurer in April, I'm going to record a $12,000 insurance expense in April. So under the cash method, it is the timing of the cash flows that matters, not when the actual revenue was earned or when the expense was incurred. For most financial transactions, it won't actually make a big difference, but in some cases it really does. Accrual accounting, on the other hand, is a method where the transactions are recorded when they actually occur, regardless of when the cash exchanges hands. This means that the revenue is recognized when it is earned, regardless of when the customer actually pays. Similarly, expenses are recognized when they're incurred, regardless of when you actually pay the supplier. Because of the rules around when things are considered earned or when they're considered incurred, things can get a little bit more complicated in the accrual method compared to the cash method. Going back to the previous examples, the revenue would have been recognized in February if that's when everything was shipped out. It doesn't matter if the customer pays you in February, March, or April. As for the example where you paid your annual insurance dues in April, that expense was meant to cover 12 months, so you'll only be recording 1/12 of that expense each month. So now that you understand both, let's talk about the pros and cons of the cash method. The main benefit of the cash method is that it's just very simple. It's very intuitive and easy to understand and implement because you only record transactions when the cash changes hands. This also means that financial statements prepared under the cash method will reflect what your actual cash position is at that time. However, there are also some limitations to the cash method. It doesn't accurately reflect a company's financial position because it doesn't take into consideration outstanding invoices or unpaid bills. You might think that doesn't matter, but let's say somebody owes you $10,000 for something that you already shipped to them. You provided the goods, you know you're going to collect it, so you've earned that revenue. But you can't show that revenue on your financial statements until you actually receive the cash. This is especially problematic for e-commerce brands or any company that has a lot of inventory. You have to show the entire inventory expense the month that you purchase the inventory. And that means that your margins and your monthly profit figures are going to look a little weird. For example, say you buy $10,000 of inventory in January, which is worth $50,000 at retail. Say you sell it over the course of the next 5 months, $10,000 of sales each month. Now January is going to show a profit of zero because you had $10,000 of revenue and $10,000 of inventory expense. While the other 4 months are just going to show $10,000 of revenue with zero inventory expense. So while cash accounting is usually more intuitive, in a situation like this, not so much. In addition, cash accounting doesn't comply with generally accepted accounting principles, or GAAP. These are standards for financial reporting that most businesses need to follow. It's possible that financial statements prepared using the cash method, which don't follow GAAP, won't be acceptable for lenders or investors. So what are the advantages or disadvantages of accrual accounting? The main advantage is that it much more accurately reflects the company's financial position. This is because it takes into consideration all financial transactions regardless of where the cash is. So financial statements prepared using accrual accounting can give you a much more accurate picture of the company's financial health. On top of that, it complies with GAAP, so most external parties will want your statement to be prepared in this manner. The main limitation to accrual accounting is that it's just a lot more complex to execute on. The rules around when a transaction is incurred is much more complicated than just when cash changes hands. For example, say you're a construction company and you're building a large development project, recognizing revenue has a lot of rules that have to be taken into consideration when it's not based on just when you receive cash. So a lot of times you'll actually need a professional bookkeeper or CPA to be able to help you to take care of your books using accrual accounting. Also, because it's not simply cash-based, there is a higher risk of error. So what's the best fit for your business? There's a number of things to consider, but a couple of considerations are, for one, your size. A very small business can get away with cash accounting, and it's not necessarily worth paying all the additional expenses to make sure that you have accrual accounting in place. Whereas a business that's actually planning on scaling would probably want to use accrual accounting because they'll need it at some point. Another consideration is your business's complexity. Say you have a freelancing business and your clients pay you every month and you execute on the work every month. You have some software subscriptions that you pay every month, but there isn't much more going on beyond that. In a situation like that, the difference between cash accounting and accrual accounting won't be that massive. However, say you have a more complex business. Maybe you have debt considerations. Maybe it takes you a while to collect on your invoices from customers. Maybe you manage a lot of inventory. In those situations, the difference between cash and accrual accounting can be massive. And cash accounting can give you a very misleading picture of how your business is doing. At the end of the day, it's for you to decide, but talk to a CPA, and for most people, just go with accrual accounting. I hope that was helpful, and if you have any questions, leave them in the comments below.